Hi, this is a short video tutorial for ICCI Belfast for financial reporting. Within this tutorial we're going to be having a look at Introduction to Preparation of Consolidated Financial Statements. So we're going to be looking at why we consolidate and what we're actually doing during this consolidation practice. So the standards that you would need to familiarise yourself with are IFRS 3 and IFRS 10. So that's business combinations and consolidated financial statements. Laid out within these standards are the definitions of a parent company, a subsidiary, notes as to why we consolidate, when we do not have to consolidate, and what we actually should be doing during the consolidation. So why do we consolidate? Well, within a group, there are very often several companies, and in their own legal right, they are a separate legal entity. However, the economic reality of the situation is that these companies they have an awful lot of influence and control over the various income and expenses of each other, and also the financial positions of the other companies. So as such, we need to try and combine these together so we can get an overall view of how the group as a whole are doing. So within IFRS 10, there are several definitions. So a parent company, this is described as an entity that has control over another entity or several other entities. The subsidiary then is the entity over which the parent has this control. So when do we need to actually prepare consolidated accounts? We need to prepare them whenever the parent has control over the subsidiary. So this could be whenever there's more than 50% of the ordinary share capital is held by the parent of that subsidiary company. However, there's other elements that will then affect control as well, which need to be noted. So can they exercise the majority of the voting rights? Are there any contractual arrangements that are in place which maybe then can determine economic policies of the subsidiary, for example? And what are the potential voting rights of the parent? Is there any convertible loans? So you need to be establishing what are these loans convertible and what management actually intend to do with them. So the concept of a group, we've mentioned this 50%. So you're looking for more than 50% of the ordinary share capital, plus those other elements that we talked about in that previous slide, to understand whether they have the control of the company, of the subsidiary company. You then also need to look to see whether they have any voting power, or do they have voting power, which is again going to back up that they have control of the subsidiary. Are they able to influence any management decisions? And then if so, if this is a parent and subsidiary relationship, then they are going to be forming a group, which should then be seen as a single unit. And this needs to then be consolidated on a line-by-line basis to produce one set of consolidated financial statements. So when are we exempt? Well, we can be exempt from preparing consolidated accounts if there is a parent and a subsidiary relationship, if that parent is wholly owned by another parent company. So if you're thinking there's maybe one parent, then the parent that owns the subsidiary in question. So if there's somebody above them that owns them, that they're wholly owned or partly owned, then we can be exempt. And you can also be exempt if you do not trade your shares on a public listed stock exchange. However, if you do not, or if you are exempt, you need to make some disclosures, and these are outlined under IAS 27. So you need to state the facts. So just simply enough, what made you come to this decision that you felt this is fine, that we do not need to prepare consolidated statements, whether it's just simply stating we are a parent company that have control of subsidiary, but we also are a subsidiary ourselves. We are wholly owned by another parent company. You also need to detail any significant investments that you have within the subsidiary that you control, and also how the investments have been accounted for. So this is just basically detailing for any users of financial statements what the situation is and why you have not consolidated. So why would directors maybe want to exclude? Well, if you think about it, perhaps a parent owns a subsidiary which is maybe not performing well, has made a lot of losses during the year or over several years. It maybe could bring down the whole financial performance of a group, and as such they maybe would try and be looking for any way of not including it. So this is something that you would probably need to be looking out for in the exam if you're maybe dealing with ethical questions. So is there a reason that you can see perhaps you're told that the subsidiaries made losses over the past couple of months or over 6 months within the year, then these are sort of issues that you need to be bearing in mind just to try and determine whether or not the exclusion or the exemption, that's been claimed for consolidation is actually legitimate. Other issues now that you need to consider whenever you're actually preparing the consolidated financial statements is, are there non-deterministic year-ends? Now this is basically, if you're preparing consolidated accounts, it would make sense that if you're going from January to December within the parent company, that the subsidiary needs to be brought in for that amount of time and for that period as well. If, however, you cannot change the periods, or it's just totally impractical to do so, there is a 3-month window before and after the parent's year end, which realistically is not going to impact that much on the financial statements, meaning you're not going to need to apportion everything within. However, if it's after the 3-month window, either before or after the year end, then you would need to try and bring in and apportion the subsidiaries' accounts to the parent company. The accounting policies within the parent and the subsidiary also need to be considered. So if you have one way of accounting for depreciation or for accounting for various other issues that are going to be presented within the financial statements, they all need to be using the same accounting policy. Now this might actually mean that you're going to have to recalculate some things using the accounting policy of the parent, just so that everything is in line. Otherwise you're going to get skewed information and the reliability and relevance of the accounts are just going to be completely undermined. Another issue is the intergroup transactions. So unrealized profit or cash in transit, or if there's a liability in one company and an asset in another, these are going to cancel each other out, and they basically do not need to be brought into the consolidated financial positions because they're going to have a nil effect, and it's just going to distort the assets and the liabilities, for example, in the financial statements. So related parties, these disclosures are key. Any related parties that are from the parent to the subsidiary, and then even again from the subsidiary to any other company that they are related to, are all going to have an effect or a potential effect on the consolidated financial statements. So you're going to need to bring these in and basically outline the related parties in great detail, outlining the control, anywhere that there's significant influence or there's common control. Well, this was just a brief introduction to consolidated financial statements. Thank you very much.